Hello, everyone. I hope you enjoy yourselves thus far. So literally a year ago, the crypto industry looked very different. The hype was in decline, but who could have predicted the cold winter we're in right now? And in 2017, the magical word was blockchain. It was considered to be the historical game changer. So we've all matured since, and much of the romance and hype has vanished. But having said that, we're all crypto believers here, I believe. And we think that mass adoption, whether retail or institutional, is inevitable. So with us, we have a super interesting panel led by Abdul Hasib Barsit, board member at Global Digital Finance, and the co-founder and principal at Ellipsis. Please.
Hi, thank you for the kind introduction. I represent Global Digital Finance, which is an industry body set up to accelerate the adoption of digital finance and digital assets and crypto. We primarily developed conduct standards for best practice with the industry. I'm delighted one of our members, B2C2, is here today. We work with over 200 firms globally and 30 global regulators. We've got a great panel for you today, a real mix of crypto industry players, investors, and institutions. I'll go down the line and ask my fellow panelists to introduce themselves, and we'll then dive right into it. So, Michael.
Hi, thanks everyone. My name is Michael Coletta. I head emerging tech and really blockchain innovation and strategy at the London Stock Exchange Group. Just a quick bit on the Stock Exchange Group. The name is a little bit misleading. We have the London Stock Exchange, Borsa Italiana. We have 40% of our revenue comes from market data, so FTSE Russell, and then another, roughly 38% comes from the LCH. And then we separately have a technology business where we sell market infrastructure like central limit order books, surveillance tools, CCP in a box type things to other market infrastructures. So that's my bit.
Thank you. Sophie.
Hi guys, I'm Sophie, I'm an associate at Anthemis. So Anthemis is the leading global early stage investor within fintech and insurtech. So we've been investing in fintech for over 10 years. We've got a portfolio of over 90 companies across UK, Europe, and the US. So while not specifically focused on crypto and blockchain, it lies within our thesis, and we think it's a really interesting time for companies at the moment.
Thank you. My name is Max Bonen. I run B2C2. B2C2 is an electronic market maker in crypto and a handful of other asset classes. And I believe we are the biggest OTC liquidity provider by volume, and we maintain a large footprint on exchanges across the globe, including OKCoin.
I am Gabor Nagy, and I am the Business Development Director for OKCoin. We are a crypto to fiat spot exchange, the sister platform to OKX, and should be considered the fiat onboarding, offboarding ramp of the OK Group.
Thank you very much for the intros. So our session is entitled After the Hype, Ahead of Mass Adoption, the State of the Cryptocurrency Industry. So I'd like to each of you to start with your assessment of where we are in the crypto and digital asset industry today. Are we post-hype, and are we really ahead of mass adoption?
Hi, thanks. So just going into the crypto, so you'd wonder what, a stock exchange talking about the crypto industry, but there's a lot to talk about, and specifically, so let's go into a little bit about where we are and where we see things. The crypto industry has advanced quite a bit when it comes to the clarity around digital asset custody solutions, right, which was kind of at the crux of investors being able to understand their risks when dealing in exchanges. And this was something that I had worked on in the past at my previous role at the CME group when we were looking at the Bitcoin future. And I think we've come quite a ways, right? So you've seen players like, just name names, Fidelity Digital Asset, for example, but others coming to the fore, right? Existing market incumbent infrastructure that are providing those kind of scalable, solid, understandable solutions. Secondly, I think if you look at the infrastructure, so, looking at crypto exchanges, to operate, most of these exchanges, right, were built on their own kind of central limit order books or through some of the specifically crypto-focused companies. I'm thinking Alpha Point as an example. Now, while these solutions met the needs of the market, they didn't necessarily meet the needs of institutional fair and orderly markets. So in other words, what kind of market data am I producing out of the central limit order book that I understand that there's no market manipulation going on? These types of questions, right, were not answered, and the functionality wasn't delivered. And what we've seen, and recently, even with London Stock Exchange, if you look at the infrastructure business that we have begun to sell our central limit order book to crypto exchanges, right? And why? So that we're giving the institutional tools to the crypto exchanges to be able to create the scalable tools that they've always needed. And I think that's the kind of the reoccurring theme, right? We're seeing it's the same basic principles and activities, right? When you're creating these markets or need to custody, right? You need to understand your risks. You need to understand that the market data and the markets are operating fairly. Just to touch on where I see some gaps, and this is kind of an interesting thing when we think about digital assets, but I'm really focusing on crypto here. The one thing that we don't think about a lot is, so we talk about democratization of finance, and that we can disintermediate the existing marketplaces and they're irrelevant. But I think the thing to focus in on, for example, in the crypto market, and one kind of, let's say, not so technical aspect of making fair and orderly markets is information symmetry. So it's kind of an industry term. So it means basically, right, that every investor that's buying a digital asset, a crypto asset, right, a cryptocurrency for that matter, is able to receive the information at the same time, so that there's not an insider list that's able to act and sell their stake in, let's say, a cryptocurrency because they happen to know a little bit more than others. I mean, those types of things are taken care of in existing financial instrument markets, right? So equity markets is what I'm thinking of. And I think that question, right, and these types of questions are really difficult to answer in crypto, and they're really relevant. And I think there's no necessarily simple solution, right? But I think we've made a lot of progress. A lot of the stuff looks and feels exactly the same. The same concerns around custody, the same concerns around market data, operating fair and orderly markets, anti-money laundering, and knowing your client. Right? It's all matured to kind of this institutional point. So I think the state is good. I think that we'll allude to it a little bit more, but I think that being pulled into regulatory perimeters will actually result in even more maturity in the market, and I think it's coming. In a good way, not in a bad way.
Thank you.
Yeah.
Sophie?
Yeah, so I think from an investor point of view, we saw this obviously extreme kind of burst and all the hype around blockchain and cryptocurrencies, and there was just a lot of people creating solutions that weren't necessarily had an end use case. They were just being created because there was this new technology and everyone was quite excited. And then you obviously had a lot of the companies that were fueled rather by speculation over utility. And of course that kind of led to the crash. Like I said at the beginning, people are calling this a crypto winter, but I think it's better to think of it as crypto spring, because actually what happened was it got rid of a lot of the bad actors, it got rid of a lot of the players that weren't going to be businesses that were going to be sustainable, that were going to generate real value and real revenue. And so actually it's quite an exciting, I think we're at quite an exciting point within the cycle. And the other thing that I think is quite interesting is that we're now sort of seeing more of, institutions kind of dipping their toe in, not really starting, but they're beginning to look at it, adding some maturity to the sector. So like you said, there's still a lot of hurdles to go. We're still far, far from, the next internet or web. But I think there are some good signs, and we're seeing some really interesting, credible companies kind of now coming through that are investable.
I think crypto is a very mature market, actually. Obviously not as mature as US Treasuries, but there's, if you want to trade crypto, it's essentially just like trading FX, with a handful of twists. 2 years ago, we said that a few things were, missing from the crypto market. One was execution technology, and risk absorption capacity. 2, custody solutions. That's a solved problem now. And 3, the problem of credit. I think credit is of that mix is the only one that's missing. You don't really have prime brokers. It's difficult to take large positions in crypto without having to pre-fund everything. So I think that's one problem that's being fixed now. So we'll see probably in the next year, we're going to have some good solutions that are going to come out. And when we're there, it's just like, I don't know, maybe the gold market, the commodities market, it's got exactly the same look and feel, in my opinion. The fact that, assets move on a blockchain is interesting, but doesn't make it a structurally different market. It is interesting, though, to notice that settlements tend to happen faster. But actually, I think that settlements are going to start happening more slowly as the market matures, because we're naturally going to have people implement more professional treasury processes. So you're going to have your spot trades. They might not be T plus 2, they might be T plus 1. And so treasury is going to come in the morning after, look at the settlements you have to effect, go into the funding market and try to do swaps and other funding trades. So I think actually the market's quite fast now when it comes to settlement, but we're going to go, it's going to start moving a bit more slowly, because people are going to fall back on standardized procedures and value date conventions and things like that. So I think it's a very mature market. There's obviously still a lot of inefficiencies, and that's why there's money to be made. But on a lot of dimension, it's come a really, really long way. Now, perhaps that's also a little bit disappointing that I think it's not a very different market. But I think that it's interesting for a lot of players in foreign exchange and similar industries that it's a way to also expand your offering and to generate a little bit of excitement in industries that really haven't been very exciting since 2015.
I think that Max makes a really good point here with regards to the maturity of the market overall. As from an exchange perspective, what we've seen is continued mass adoption from an institutional perspective and significant new corporate accounts being opened, especially from trading businesses who are large in the traditional market space and are tipping their toes into the digital asset space. But more importantly, the guys who have been incumbent for a number of years in the crypto space are expanding operations, headcount, volume, exposure in a significant way. So yes, there's still a long way to go for full mass adoption, but we're certainly moving in and trending in the right way.
So I just want to touch on something that's come across there, which is that there's varying views on levels of industry adoption or institutional adoption. And so, Michael, as the institution on the panel, do you think that institutional adoption is a prerequisite to mass adoption, or are the institutions, as Sophie describes, dipping their toe to an extent for now while they get more clarity and certainty in this sector?
Yeah, so just to answer the question on do I think institutional involvement is necessary for mass adoption? I truthfully do, just because of the way that we access and commoditize financial services today. And when we're looking at, for example, things that are scalable, like that were mentioned, that kind of launch financial products into the real world, like extending credit, being able to clear, to risk manage, these types of things, right? Creating derivative products and crypto options, right, that allow these things to have a liquid market and discover a price, right, and for speculators and hedgers to be able to access and use this instrument as a proper underlying commodity, if you will. So I think it's absolutely necessary, because if you look at it as well, if you look at the, there's been a big push for these crypto ETFs, right? The Winklevoss twins were really trying to get into that, right? So people in the US wanted to invest their retirement accounts in that. You've seen some types of exchange-traded products in Europe. Specifically, I'm thinking of NASDAQ OMX. Now, that's not a passportable ETF, but the underlying issue and the fundamental issue that we're still kind of facing here is that unless these products, and this is the funny part about it, right? Because crypto's always been at the it's kind of the rebellion of, it's the rebellion of the incumbent. I mean, that's the spirit of it, right? The cypherpunks. But ultimately, in order for adoption to kind of take hold, these things need to be pulled into regulatory perimeters, and that's the direction things are going. And I think that's why we're seeing actually a little bit more institutional toe dipping / foot dipping, if you will, because you have things like the anti-money laundering fifth anti-money laundering directive that basically is regulating crypto to fiat and so it's finally like, okay, we can understand that these are that these products fall within a regulatory perimeter and we know exactly how to operate. I think the problem was institutions didn't know how to operate, didn't know how to treat the risks they were facing, right? And when that happens, then you can't really create something like an ETF. You know, it's not UCITS compliant, if anybody knows what UCITS is, right? So it allows essentially, you know, fund managers to be able to buy funds of these underlying assets. So I think 100% necessary.
Thank you. Very interesting. So, Sophie, flipping that on its head then, as an early stage investor, what are the trends that Anthemis is most interested in this space, and where do you see opportunities for scale and adoption? Is it B2C? Is it B2B? Is it a hybrid?
Yeah, so I think maybe some of you have heard this analogy before, but a lot of people kind of likened the kind of Bitcoin crypto sort of price increase and hype to the California gold rush. And so when we look at that, we think about, so yes, a lot of people made money from mining gold, but actually the entrepreneurs on the side that were then decided to go and produce picks and shovels to help people mine the gold became very, very successful and wealthy engineers and wealthy entrepreneurs. So that's kind of how we think about where we look to invest, which is it's not really the underlying technology or potentially the currency itself, but actually those tools and companies that will be able to support the ecosystem as it grows and evolves. So for example, we just invested in a company called Kaiko that does institutional grade market data. Now, market data is always going to be required, no matter what the coin, no matter what the asset. And so actually investing in companies like that, where you're taking less of a risk of the underlying sort of structure, but actually of really backing the fact that we think capital markets will transition onto the blockchain and that there will be a new ecosystem that will arrive around that, I think is where we look. The other kind of area that I would say is interesting for us at the moment is before maybe a year or two, you were seeing a lot of first-time founders, very technical founders coming in and building sort of technical-based products, like I said, which was more maybe because they could rather than an end utility. Now we're seeing a lot of second and third-time founders. We're seeing a lot of founders coming from big institutional banks and financial services coming into these companies and setting them up. And I think that's a real credit to this, to cryptocurrency and the state of it, which is, people are willing to leave very stable jobs to come and create new exciting companies. So I think that's a good trend that we're seeing.
Very, very nice segue to people building new and exciting companies. So Max and Gabor, I guess as exchanges, brokers, it'd be really good to get your perspective on where you see the growth drivers geographically. What are some of the differences you see between Asia and the Western world? And what are some of the drivers and barriers that you've noticed or faced in your businesses to date?
Yes, and I want to offer a contrasting view here. You mentioned that some people are leaving very high-paid job to get into crypto. Yes, but also I remember a lot of people left high-paying jobs to get into crypto, didn't work out, and they went back to the banks exactly at the absolute ding-dong bottom, right? So I think that we have to be careful when people from institutions join the market. They might be a signal of either market bottom or market top, because when it comes to institutions, believe me, the institutions that need to be in crypto, they're in crypto. You've got some serious players, very institutional players, are trading crypto today because they have a business model that they need to be trading crypto. And it remains a very speculative market, so you have a lot of speculators, high-frequency trading firms, and the like. But if you're thinking, when is BlackRock going to get into crypto? Possibly never, because that would mean they would need to have a mandate. It goes way beyond, just, they need to have some... Well, another way of saying this is that a lot of people have tried to build a business around the principle of build it and they will come. Turns out they never came, right? So a lot of the companies that you see have beaten the dust recently, they were sometimes very institutional, but their business was not geared to the right institutions. So they found it very difficult to survive the crypto winter. So that allows me to segue into the geographical distribution. I'm sure Gabor would be able to talk to that. You've got a huge divide in the market between the heavily regulated side of the market and the completely cowboy unregulated side of the market. And it turns out that thus far, the unregulated side of things has been way, way more successful and profitable, right? And I think there's reasons for that. The reason is that, again, if you just want to build it and it will come, you might not be targeting the right segment. When you look at the most profitable business in crypto right now, it's an exchange called BitMEX, based in the Seychelles, completely unregulated. They're making on a bad day $5 a day, right, in revenue. That's on a headcount of maybe 75 people. It's amazing. And a lot of people like Coinbase and the people that really went down the road of, you mentioned the Winklevoss twins, so Gemini is really struggling to get traction. I think that's because, to some extent, regulation has been a little bit heavy-handed and has pushed activity outside of its main perimeter, which is a bit of a shame, I think. But now what you see is that a lot of very unregulated businesses are coming up to try to compete against the likes of BitMEX, and they're doing really well. And what you see is that the natural maturation of a market that you would expect to see in any normal industry is happening, but it's happening not on the regulated front, but on the unregulated side. So now you have different unregulated exchanges catering to different user bases. So they're finding their own little niches, but the niche is not regulated versus unregulated. You have sub-niches within the unregulated space. And I think that's something that we have to respect, the fact that those guys have managed to build very big businesses by taking a big risk that regulation was not necessarily going to be, at least for the past, I guess, 3 to 4 years, the way to go.
I think Max makes a really good point here with differentiating between the regulated and unregulated side of the market. So, for example, with OK Group, we've got OKX on one side, the unregulated futures swaps exchange, does obscene volumes on a daily basis. And then we've got OK Coin, the regulated fiat to crypto side, which does significantly less. But moving from that to headcount, I think it's, or from a geographic perspective, OK Coin started back in 2013, and we were very much Asian focused back then. And since then, we've moved into the US. We service 20 states in the US, and recently into Europe to look after our European clients. But the main drivers of geographical location, or the growth areas, I think, is going to come from Europe, as we're quite behind relative to Asia and the US. And how that is going to develop from unregulated to regulated markets, there's lots of unknowns yet, but the fact that the regulators have been heavy-handed in that respect has driven more volumes down that sort of the futures swaps part of the market. There's probably a very good case that eventually that will come back into regulated form at some point. But we're seeing quite big growth in Germany, especially in recent months, on OK Coin. And with regards to the main risk attached to what we see is actually staying competitive. Staying competitive in a space of continuing to and continued product development, innovation, but within that regulatory framework, which is uncertain. So that's kind of where we are. Certainly, we are growing at a significant rate. We've got nearly 1,000-person headcount on the OK Group in total. So it's a significant business, but I think there's plenty more space to grow in coming years.
May I give an example? Something that happened this week. I think around 2 years ago, an exchange called Poloniex was the absolute top dog in crypto trading. They were handling something like 40% of global volume, and they had a huge business. They were acquired at the very top by a US company backed by Goldman Sachs and a handful of others, a company called Circle. They paid $400 million for the business, and they intended to turn it around. It was very much, the Wild West over there. They wanted to, maintain the volumes and all the user base, but go, really regulated. They tried to do that, didn't work. They even tried to they went to the Bermuda, right? Because they thought it was going to be easier the regulators would be friendlier. Long story short, that business has completely died. It went from 40% of global market to perhaps 0.5%, if that, right? And what happened this week it was revealed that Circle, the US company, is really struggling right now, and they spun off that exchange, Poloniex, to a consortium led by a Chinese individual called Justin Sun, who is widely seen as some sort of scam artist or, famous personality in the crypto space. It's all very superficial. So when you look at the job that the regulators have done there, you have to think that it's a bit of a shame. There's so much talk of America first, America first. Well, you had in the US a brilliant business, the top in its industry, and it's been driven out to Asia, and they're going to try to go back to its roots of a Wild West to compete with the likes of Binance.
So I think this brings us very nicely onto our sort of regulation question. So we've sort of identified this tension that regulatory certainty is important, but where we're seeing most of the adoption is in the unregulated space. So how does the industry moving forward manage that so as not to kill every activity while bringing it into regulatory perimeter? I'd like to hear your thoughts on that.
Well, no, I just wanted to come back to the heavy-handed thing. So I agree that out of like American policy bodies, you tend to see very heavy-handedness. I think somewhere between an over-aggressive approach or even more over-aggressive approach of like ban everything, right? Like so China, right, just completely banning crypto exchanges as an even more extreme example of that. Or you come over to Europe where it's kind of like, well, it doesn't really fall in the perimeter. We haven't really opined on it. So the issue really is it's somewhere between banning and saying, well, let's bring it into the perimeter and let's just treat it the same as the existing asset classes is the right answer. I think that the heavy-handed approach usually comes from it's the typical thing around anti-money laundering, right? Like this is all going to be, it's all black money, it's all dark funds, right? It's just not the case anymore. So I think that's where some of the heavy-handedness comes from. But I don't think, and I don't think that bringing, like if you were to qualify cryptocurrencies as a, equivalent to what, we define as a financial instrument in some way, right? Because it looks and feels a lot like that when you're creating financial markets. I don't think it would come across heavy-handed, right? Banks would be comfortable giving bank accounts to crypto exchanges that abided by, creating fair markets, right, and releasing their market data and AML KYCing their clients, and things would grow and you could develop financial products. So I think the heavy-handedness is just the plain labeling, crypto bad, crypto equals terrorist finance, money laundering, right? Like that's what we have to be careful about. But I do think there's a gentler, kinder way to bring it into a framework that we already well understand. So I think the institutions stay out of it and the growth isn't happening. And I do appreciate that the kind of like the small niche markets, but really for the scale, if you just have a little bit of institutional comfort, then this asset class can still have its niche places, and you can have scale at the same time. I think at this point it's kind of it's suffering from that, right? And there's a lot of work to that end, right? So I mentioned the 5th anti-money laundering directive. That's helping with crypto to fiat, but there's a lot of work being done in Basel III on the risk treatment of crypto assets. The Financial Stability Board as well. So this is actually really good news. It's not heavy-handed. It wants to recognize this as an asset class. It wants to support it, and it wants to create fair and orderly markets.
So the thesis would be that if you had the regulated option and an unregulated option, everyone would, go for the regulated option.
It's not binary though. Like depends where. That's my point.
It's
So like America is one thing,
yeah.
right?
One thing I see is that around 80% of B2C2's volume on the OTC side come from regulated institutions. So it's quite, an institutional business. And B2C2 was the first the crypto company in Europe to receive the MiFID investment firm license, the 730K license. And so we offer, regulated OTC derivatives and cash trading, which is unregulated. The cash trading is, it's an order of magnitude bigger than the regulated business, and it's not because we don't push the regulated business. In fact, our regulated clients, and I'm talking, serious players, people with, billion-dollar balance sheets and people that do in foreign exchange, tens of billions of dollars in daily volume. Those guys say, no, we're good. We're happy to trade your unregulated product with you. We have regulated entities, unregulated entities, and really they don't mind, right? So at the end of the day, a business like OKCoin or ours, we have to follow client demand. if clients demand something, then we have to offer it. And if they happen to not demand regulated products, then it's difficult to go. I mean, we try to go out of our way, to put a wrapper around it that's more regulated. But that's been, just it hasn't been a winning recipe. Now, you say there's the niche. I think actually today the niche is the regulated products. If you look at the Amun, I guess ETPs you were referring in Switzerland, we looked a couple of days ago on Bloomberg at all those, exchange-traded products that track crypto. Volume was like, across all those products, something like less than $10 million ADV. It's just nothing. And I think that goes to show that people are not really interested in that. Sadly, I mean, I come from a very regulated background, so it would be easy for me to say, hey, if you get regulated, it's a big barrier to entry, everyone's going to flock to you. But it's not the case. I would love to have a big barrier to entry just because I have a regulatory license, and I'm sure Gabo would like as well. And so what I find is that simply that's not necessarily something that people are very interested in. And in fact, what is really interesting, I think, about the crypto market is that it is the last market that is open access and level playing field. And that's something that I think everyone in the industry wants to keep.
So just going to the point on, the point wasn't that, where that today, where we are with regulation and looking at the products that are quote unquote regulated, it wasn't the point of looking at it where we are today. It's saying that it's actually lacking a lot of, the crypto market itself is lacking a lot of frameworks. So sure, where there are like kind of little bits and pieces of activities that you could regulate and provide services around in the crypto market, there are services, but I'm saying that there is no complete framework. So I'm just saying backfill what's missing. So I think that the reason why the asset class doesn't really have the kind of vast uptake in the regulated side is because there's no actual framework by which you can regulate it currently. So that's all I'm saying. And I think when you say open access and fair markets again, like information symmetry, like these are questions that kind of sit out. Are investors protected? Are they all receiving the information they need to make a decision on something that would impact price at the same time? And it's not to say that existing financial markets are completely fair that way either, right? But these are real concerns, right? So again, I would say, I'm just saying that if we put a structure, around like a regulatory structure such that banks are comfortable providing bank accounts to crypto exchanges, that they fully understand the risks that are being taken, then it will scale. It's more just a thing of scale, right?
So I feel we could have had an entire panel on just the regulatory topic, but just stepping aside from regulation for the moment and looking at various solutions that are lacking or have been recently developed in the industry. Maybe Gabor, but to start with you and then Sophie. How important have development of custody and insurance solutions for the sector been, and what else needs to be done in these spaces particularly?
So what OKCoin and OK Group are doing currently is actively integrating with a handful of regulated custody solutions platforms. One of the largest issues for mass adoption has been that differentiator between who holds the funds and who trades the funds, which has always stopped the sort of real outside money that's managing funds managing outside money get involved in a meaningful way when it comes to their relative AUM. So what we're trying to do is front run the potential for that floodgate to open, which will have to be executed through some form of custody solution. So we're working on integrating and being able to represent those custody clients' assets on exchange. This hasn't really happened yet, but we are ready for that move to develop.
Sophie, do you want to comment on the insurance topic?
Yeah, and I was just going to kind of draw on that point, which is if you believe that capital markets is going to shift onto the blockchain, then you have to believe that solutions like custody, insurance, issuing platforms are all going to mature and become, either institutions are going to start providing these solutions or you're going to have new incumbents emerging. And so, that the speed of that will all be very dependent on regulation or things that we've talked about, and also kind of trust and credibility of the underlying solution. So I think that I think it's something that needs to happen, and whether that will happen in 2 years or 10 years, who's to say? I think we were discussing about the insurance kind of issue earlier. It's a scary space for a lot of insurers, and there is just such a lack of data. So, underwriting usually relies on vast amounts of historical data to price risk accurately. Insurers as an industry is quite old-fashioned. They're not used to using alternative sources of data and anything like that to support them. And actually, while everyone thinks insurance is pretty boring, it's pretty fundamental to the ability for this to be, for mass adoption of things like digital assets and things like that. So, and I know there are startups that are working on it, very, very early stage, nothing that we've seen of really kind of interesting, and none of the other insurers are really touching it with a barge pole. So I think it's an interesting space.
So thank you very much. So before we wrap up, I'd like to give you, the audience, a chance to ask questions. There is a roving mic at the back, so please raise your hand if you'd like to ask our panel anything related or unrelated to what we've just discussed. Please, could you introduce yourself, and if you want to direct your question to anyone in particular?
Hi, my name's Dominic from Windbridge, trading FX in Switzerland. So it's not really related directly to my field, but interested in the sort of lack of mention of tokenization, or whether when you talk about crypto, you're actually including that in the general subject matter, and also the changing appetite for tokenization solutions, in parallel with the whole crypto question.
So I would contextualize this, that I was taking the entire discussion's context for cryptocurrency, right? And I wasn't touching on any of the tokenizing existing assets, which actually, while somewhat related, is a very different is a very different discussion. So it was by choice that I didn't mention tokenization, just for the focus. But so tokenization is totally. Look, it's a totally separate kind of issue over here, because essentially so when we go to crypto, it's kind of like, these are digital assets with no central issuing authority, right? And it's really an interesting space because of that exact fact. And then when you come over to tokenization, really it's a question of what rights does the token confer upon me, the holder, and legally, right? Because that's how I value something, that's how I know my rights, that's how I can scale it. And when you get into tokenization, then you start getting into all these kind of questions around kind of economies, national sovereignty, market stability, right? All these types of things, right? And we get back to all these kind of fundamental questions of how financial markets actually work today. And I think so. The tokenization topic has progressed quite a bit. I think we have 100% clarity that the word token it's meaningless to me, in the respect that I always look at the legal definition, right? Because it's always a question of an asset is always a question of what legal rights does that confer upon me. And I think that is 100% clear. I think from a European perspective, right, the regulatory, reg is a very vast space, but what I would say is that basic fact is recognized. The classification and understanding of cryptocurrency versus, let's say, a security token is well understood. And the concept that we could use digital assets or blockchain to scale finance and unbundle some of our centralized financial services, much as like banks have been unbundled in Europe, is possible. And there's quite a bit of progress being made across a bunch of the European Commission and European standard setting agencies, right?
If I can add something to that. So we're talking about centralized tokens, right? We're talking about putting Facebook shares on the blockchain. So far, none of that has taken off, and I think I'm a bit skeptical personally, because you're not gonna be able to circumvent the existing regulatory infrastructure. So you're still gonna have to have a CSD and everything. And so if you put stuff on the blockchain, you're just gonna double the costs. Maybe after some people have taken the hit and doubled their costs for 10 years, the regulators will be, okay, now we feel comfortable. If you put it on the blockchain, you don't have to do all the regulated stuff because it will be included in the blockchain infrastructure. Maybe, but that's like 10 years plus. In the meantime, there has been one issuance of a token that has been extremely successful in the crypto market. There's a bank, it's well known, but I'm not going to name it, has tokenized its client deposits, its customer deposits. And that has spread like wildfire. Why? Because there's a very simple use case. Fedwire in the US is closed on the weekend, so is SEPA, et cetera, and so you can't make payments on the weekends. But by tokenizing their deposits, they're allowing their clients to trade with one another and settle over the weekend. And that's fantastic. That's really interesting. But at the end of the day, it's got nothing to do with consensus mechanism or the blockchain. It's more, those guys have put together some tech, some database. They said, the deposits are going to be taken out of the core banking infrastructure that doesn't work on the weekends. You guys are going to be able to move money around amongst yourselves, all clients of the same bank, during the weekends. And then I suppose on Monday, you can move the funds back into the core banking infrastructure and it becomes a normal, real, quote-unquote, deposit and you can do wire transfers. So that's been really successful. But that's the only example that I know of.
I think time for one more question from the audience before we wrap up.
Yeah. Just one question. Why do you think, in some cases where cryptocurrencies hasn't been widely adopted yet in some places such as the UK or the US?
Did you catch that question?
Why
the difference between why cryptocurrency has and hasn't been adopted in different jurisdictions?
Yeah. If I clarify it, what factors are holding back widespread adoption of cryptocurrencies in the developed world, such as
okay.
My 5-second answer is that because the payment system in the US and the UK works kind of okay, and so we haven't needed it that much.
I would also say that actually UK, for London, is one of the biggest hubs for crypto trading in Europe. So,
but I'd agree with you on to answer the widespread question. Yeah, I tend to agree there, right? On the banking.
Thank you. Thanks very much for your questions as well. We are running out of time, so I'll ask my panel to wrap up with just a 1-minute answer on your industry outlook. If we're sitting here in a year's time with this exact same panel, what will have changed and where do you see the industry going? Maybe start.
Hopefully volumes on our exchange have tripled.
Yeah, hopefully bigger volumes. I think we're going to see the market's going to be more mature, pre-clearing, funding will be much more, box standard. But we're going to see, I think, a still greater divide between the regulated and the unregulated side of the market. And firms like B2C2 hopefully trying to cross the chasm by, servicing both sides.
Yeah, I think we'll see some more mature startups in the space that are becoming scale-ups, employing a lot more people. And I think we will see more institutional involvement.
You're going to see clarity from every type of major international standard setter body. So from Basel III, working on how we treat crypto assets, to obviously FATF, the European Commission. That will lead to your first. My prediction is in a year's time you'll see your first real electronically traded fund with a digital asset, crypto asset underlying, and I think you'll see a greater scalable institutional adoption because of the clarity given from those bodies. So I hope not more divide, I think less divide.
And I think as GDF, as an industry body working with global regulators and supranational bodies, we welcome that clarity and look forward to working with them over the next year as well. Thank you very much for your attention, and thank you very much to our fellow panelists.